Now, here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton. Every night bring you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Well, coming up, the big four banks sliding after CBA CEO Matt Comyn and Westpac CEO Brian Hartzer faced a parliamentary grilling. We get all the details with Sky News political reporter Annalise Nielsen and CLSA analyst Brian Johnson. Wall Street taking a dive.
A retailer reliability obligation will encourage investment in dispatchable generation.
Wall Street taking a dive. We'll talk through why that is with Lorraine Robinson, Head of Research at Evans & Partners. And is the National Energy Guarantee set for a resurrection? Talking those comments with Energy Minister Angus Taylor. Well, starting now with today's top story, and Commonwealth Bank CEO Matt Comyn has told a parliamentary inquiry greed played a role in the high levels of misconduct exposed by the Banking Royal Commission. Mr Comyn was the first leader of Australia's Big Four to be questioned by the politicians at the inquiry in Canberra, and says the CBA has been too slow to identify problems because of a failure of leadership. Well, Westpac CEO Brian Hartzer also faced the committee today, and for more on what went down, Sky News reporter Annalise Nielsen joins me live from Canberra. Annalise, well, of course, you've been covering all the Royal Commission as well. How did the two CEOs fare today?
Well, it was pretty interesting, actually, to see what seemed to be two very different approaches, because we saw the Commonwealth Bank come in and they were ready to eat crow. You could see that they came in with their opening statement where they apologised profusely. Like you said, Matt Comyn said that greed had really motivated a lot of it, and I think a lot of that had to do with the fact that a lot of the things they're getting accused of have been pinned on Ian Narev, who we know has since retired, and so they're trying to look at the future from their perspective. But what we saw from Westpac was probably more of a conciliatory opening, where they were saying that they had learned hard lessons from the Banking Royal Commission and it needed to happen. But then they were pushing back on a lot of the questions, and in particular we had some pretty terse interaction between Greens MP Adam Bandt and Mr Hartzer about his remuneration. This has to be one of the most sensitive topics for bank executives. As you know, they're always pushing the point to say that it's a global market and they have to compete with other banks around the world to get the best executives, but it's not the kind of thing that plays very well with your average citizen. And so Mr Hartzer was grilled about his $5.5 million salary from last year, and this is what he had to say to Mr Bandt.
Substantial. I mean, in that particular matter was the greatest disappointment of my professional career. It was a number of failures of both capability and understanding of the steps that were required to ensure that we were adequately discharging our financial crimes obligations.
Sorry, that was Mr Comyn there. So that's when he was being asked about the AUSTRAC issue in particular, because that has to be one of the most high-profile and serious issues that the banks faced in recent times. Now, we know that was outside of the Banking Royal Commission that came up, but the questions about leadership and oversight of that particular issue is something that's been examined within the Banking Royal Commission and is likely to be examined in the next round of hearings. And so that was Mr Comyn saying it was one of the worst issues he's ever faced. But Mr Hartzer from the Westpac Bank was also asked about his remuneration, about his salary package, and whether that had been impacted by the Banking Royal Commission.
What is your total remuneration?
Well, my pay is fully disclosed every year. Last year, my pay was $5.5 million.
Has there been any significant decline in your pay as a result of what has come out in the Royal Commission?
Well, as I said, 2/3 of my pay is variable, and I certainly understand people's interest in this. As a matter of fact, a third of that pay has been zeroed out over the last couple of years as a result of the overall performance of the company.
A lot of people would say that $5 or $6 million is a lot of money to receive full stop, but let alone when there's been so many findings of wrongdoing by your organisation. What would you say to those people?
I would say I absolutely understand it's a lot of money, and I recognise that, and I understand the interest in the issue.
So, Ticky, I thought that was really interesting in particular because it shows about the intersection that these inquiries and also the Banking Royal Commission has brought between the public perception of the banks and what they're doing operationally, because many within the banks wouldn't think to question that kind of salary when they're saying we have to compete globally. But for your average citizen, it does seem something quite on the nose. And that really was the kind of questioning we were seeing today. We heard questions asked if they how they sleep at night and things like that. And so it really was quite some intense questioning that they faced.
Interesting, because of course the Greens, Adam Band, equity is such a big issue within the things that they care about. This Annalise is a bit of a dry run though for when they appear, all the CEOs at the Royal Commission itself. Do we think they're going to get the same sort of inquisition?
I think it's going to be a lot tougher, because what we saw in these hearings today was they were using the fodder that had come out of the Banking Royal Commission. They were asking questions about how did they justify using an elderly, disabled, incompetent grandmother as a guarantor, and that was already examined in the Commission. We heard about farmers being charged for loans, loan defaults and things like that, and so these were the politicians really grilling them about why they did that. But I think the Banking Royal Commission has the opportunity to get that evidence, to disclose it to the bankers beforehand and really grill them on it. But it will be a dry run in a sense of they were being asked a few policy questions, like that one about remuneration, but also about their interaction with ASIC. And so I'm sure the Royal Commissioners will be listening very closely to what they've said, because that will help them design their questions for the last round of hearings.
You're right, I'm sure they'll be watching. Annalise Nielsen, thank you very much for bringing us up to date. Well, let's see how the Big Four did move in response to today's proceedings. And, yeah, take a look. Down. ANZ down 3.2%, CBA down 2.9%, NAB down 2.5%, and Westpac down 2.6% there. So, where to next for the banks? Well, for more, let's cross live to Brian Johnson, equities analyst at CLSA, who joins me live from Sydney. Brian, yes, it's we're swapping. I'm in Melbourne here today, but look, you've probably heard that all of how people went, how the CEOs went in the parliamentary inquiry there. But there's been a lot of other action as well. What about all this provisioning that's come through?
Yeah, it's look, I think one of the things is that if we have a look in other jurisdictions, a lot of the regulatory costs and the fines, they just keep on happening, so the market thinks they'll happen every single year, and it attributes a PE multiple on them. Whereas in Australia, when you have a look at it, perhaps they might certainly continue for like another 18 months, but we're unlikely to see years of this. And the other point to note is that a lot of the fines for the legal breaches that we have seen, it will be covered by the existing legislation, and the existing legislation, the fines aren't really that big. So one of the outcomes of the Royal Commission is, as you read it, we're going to get fines and penalties which might seem like a lot of money, but really they're very manageable for the banks. And I would hesitate to actually suggest that anyone sells, for example, Commonwealth Bank because they've copped a $700 million fine. In the scheme of Commonwealth Bank, provided it doesn't happen every 6 months, that's not a particularly big number.
Well, when you say it's not a particularly big number, it wouldn't have been a big number, a year or so ago before all this vertical integration started unwinding. They are actually going to be rather smaller operations, aren't they? Won't it still be quite big?
Well, if we actually go through, and you've got to remember, there's, the biggest issue at the moment is basically the politics of banking. The Royal Commission is all very interesting, but to be quite honest, if you'd watched the Four Corners program on CommonSure, we knew there was something wrong in the banks many, many years ago. It's just that it now kind of bubbles up to the surface. But at the Royal Commission, and I follow banks closely, but there's been very few things that I wasn't kind of vaguely aware of. So the bigger implication, I think, of this is what does the Royal Commission do to basically banks from a political perspective as we head in towards this election. So when we have a look particularly at Commonwealth Bank, if we take out the one-off type items, last year they made a profit of $10 billion. And even within that $10 billion, there are a whole lot of bits and pieces, things like breaking hedge costs that they took through the cash earnings, which if you add back the AUSTRAC fine, it reduced that number by something of the order of 6 or 7%. So I think at the moment what we've got is CommBank, they need to be very contrite. I've spoken before how one of Matt Common's major jobs at CBA is to be able to look down the camera and say, sorry, we've made big errors in the past, and guess what, they have, and it won't happen again. And that's basically what we're seeing at the moment.
Well, exactly. You said that a few times today, as I understand. But coming back to the provision, the reparations, I think Matt Comyn called it an investment of $850 million today, repaying customers for sort of basically bad behaviour on the bank's part. Now, when the banks squealed at that bank levy that came in from the government, that doesn't compare to the size of, what is it, $2 billion that the big four are going to have to pay up. It's estimated at the moment, I think.
Well, Ticky, let's just go through the maths on this, and this bank levy that they all squealed about. The bank levy is 6 basis points from July 17. That costs the banks, the 4 major banks, it costs them about $1.4 billion a year. Sounds like a big number. It's tax deductible. So it really costs them about $900 million a year.
Right,
the flip side is the thing that makes the banks in Australia to look very, very liquid is a thing called the Committed Liquidity Facility. It's this line of credit they get from the Reserve Bank. And if I have a look at the economic pricing of that, it's probably $700 million, that kind of order of magnitude, compared to the alternative of actually holding a Commonwealth Government bond. So really, you know, the net result of that implied subsidy versus the levy is about $300 million, which isn't really all that much. And the other thing I'd flag to you is, and you know, we all see these things, but we never focus on them. It strikes me that when we have a look in Australia, deposits are guaranteed under the financial claims scheme up to $250,000. Now, who is actually guaranteeing that? It's the government. Now, what happens under the financial claims scheme is basically if a bank goes bust, I get my $250,000 back from the government and they levy the surviving banks. Now, when you think about it, is there a scenario where one bank in Australia goes bust and they're not all under pressure? And in fact, what happens is the way that mechanism works, it means Westpac's problem is ANZ's problem, which means the financial claims scheme all comes back to the government purse. The Australian banks, you know, we hear a lot of whinging and whining about this incredible taxation, but these banks enjoy a tremendous subsidy from basically the government. And it's just often ignored. And so, you know, as we head into the election, we're going to hear a lot of crazy spending and perhaps some really sensible spending. But it just seems to me, if I was a politician, I want to get votes, I'd be increasing that bank levy.
Right, OK, so that was my question. You talked about the political risk. You think that's the fear, that they'll raise the bank levy because they wouldn't pull away from the guarantee, presumably. That's the other thing they could do, I suppose.
Well, they could, but no, you wouldn't do that, and you certainly wouldn't do it, you know, as we head into, as we're progressing through October 2018, and everyone kind of thinks about what a dramatic day today was. Ticky, can you remember what happened on the 19th of October a few years ago? Yeah, I can. Yeah. And then it's a dangerous
so that's the big risk. That's the big risk, though. What about the call for scalps, Brian? Though, you know, Bill Shorten was sort of saying that everybody he speaks to says, why don't these bankers go to jail, sort of thing?
I think what we hear politicians speak about at this particular time of year as we head into the election, particularly when you're in opposition, this is really just electioneering and politicking. But are some of the bank's executives personally accountable? Yes. And that is the wonderful thing about what's called the Bank Executive Accountability Regime. It will come out of their pay. And that is one of the reasons, I think, why we're suddenly hearing the banks talk about these big remediation payments, because if it's going to come out of my pay, I may as well have one really big number that comes out of my pay next year, so my pay the year after looks pretty big. And so that's one of the reasons why all of a sudden, you know, we can see the Royal Commission, we can see today's hearing, but the really big one is under Bear, you are encouraged to deal with problems quickly, and that's what we're seeing. But as far as this idea that we should be going out and, you know, stringing bankers up and shooting them, I think that is crazy. But the point is that we do need some behavioural change in the industry, and what we can see is that is actually happening.
Anna Bligh put made various changes to the banking code yesterday. Now, what about the breach reporting side of things? That extraordinary report that came out from the regulator, showing the amount of time it took banks to actually identify the breach. I think it was five and a half years to actually repaying customers. How will that change, do you think?
Well, it's going to shorten. It's going to become a lot shorter. You know, so we've seen all the banks, like literally in the last few days, come out and announce some tremendous remediation provisions. And I must admit, you know, if I think that someone got some poor advice in 2008, and here we come along to 2018, I finally decide I'm going to remediate them, that's 10 years of poverty that a lot of people have basically lived in. So, you know, the remediation payments will come out. There'll be a faster process. But what is interesting is when I speak to the banks, they try and actually blame ASIC in part for this. And I think that even comes back to a lot of the political response, because you cannot have a really strong regulator when every political cycle, every budget, we seem to take regulatory money away from ASIC, and then we decide to get tough on banks, so we put it back. There's got to be some stability in the funding for the regulator, and we haven't seen that for many, many years.
Yeah. So when it comes to banks as investments going forwards, as you say, we've got the election campaign, we've got the final report from Kenneth Hayne coming down in February. What would you be thinking about as an investor in one of the big four banks at the moment?
Well, I'd be thinking of one thing: is Labor going to win? And if your answer is yes on that, then we've got to entertain the fact that negative gearing on existing properties is removed. That probably means property prices fall. We remove the cash refund on franking credits, which basically means dividend yields aren't as attractive as they were. And we've got the risk of the promises that we hear during the electioneering basically means that the levy goes up, which means perhaps we really don't know what the earnings power is. So when we have a look at the banks at the moment, if you were to increase the levy by as little as 7 basis points, that would basically wipe out the entire housing repricing that they've done. Now, the other thing is, when I have a look at valuation excluding that, they're trading at the moment on PEs that are about 81% of the ASX 200. And believe it or not, even though the banks have underperformed for basically 3.5 years, that's probably more or less in line with the long-run average. But when we have a look at the forward outlook for them, the growth rate is slowing. We can see slowing credit growth, we can see margins fading, normalised financial markets, and at some point loan losses go up. So rather than going on and saying they look incredibly cheap, they don't, absolute dollars, they probably look to be reasonable value, but with some earnings risk going forward. But the one thing the banks do have going for them is the lunacy of some of the valuations in the market. Now, in Australia, if we were to break the market up into resources, banks and non-bank industrials, because $1 billion a week flows into the equity market because of compulsory superannuation, the non-bank industrials PE has exploded upwards to about 21 times. That is unprecedented. And so what I'd flag to you is the one thing the banks have got going for them, trading on about 12.5 times with dividend yields of 6%, they certainly look relatively cheap compared to the rest of the market. But the problem is that's not absolute dollar cheap. So I'd still be inclined to actually be very cautious on the banks at this point and be very selective on what I'd actually been looking to buy.
Brian Johnson, always absolutely fascinating to get your views. Thanks so much.
Thank you.
Well, after the break, of course, the shine has been taken off our market. Wall Street sliding at the close with volatility spiking. We'll get more details from Lorraine Robinson, Head of Research at Evans & Partners.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, as he flagged, the Prime Minister is fast-tracking tax cuts for millions of small and medium businesses. The move, 5 years earlier than expected, will deliver a 25% tax rate for Aussie businesses with turnovers of under $50 million. That will cost the government $3.2 billion over the forward estimates, but we'll see more than 3 million businesses pay the reduced 25% rate from 2021-22. Mr Morrison said he's confident he can pass the accelerated cuts through the Senate as early as next week.
Why would the Senate want to stand in the way of tax cuts for small and medium-sized businesses? They voted for them before, and they voted for them for the right reasons. The only people standing in the way of lower taxes for small and medium-sized businesses is Bill Shorten. Bill Shorten's small business policy is about making larger businesses smaller by making them all pay higher taxes.
Well, we are in campaign mode. Labour leader Bill Shorten says he has an open mind about supporting fast-tracking company tax cuts.
In a beauty parade between giving tax cuts to corporations and funding education for kids, to funding our hospitals, making sure that the sick can afford to see a doctor, I'm always going to pick our kids and I'm always going to pick the sick over corporate tax cuts. But if it's affordable, well, then we'll look at doing both. But at this stage, we want to crunch the numbers, and I need to go through the proper processes of consulting with my colleagues.
Well, as I was mentioning, a big day for global markets today, with Wall Street sliding overnight. The S&P 500 sectors tumbled, all of the sectors actually, with the broad index falling 3.3% down for a fifth straight session, its worst stretch of trading in nearly 2 years. The Dow Jones sinking 3.1%. It was really the Nasdaq that took the biggest hit, down 4.1%, with tech stocks taking the brunt of the impact. So what triggered the sell-off? And how did this play out locally? For more, I'm joined by Lorraine Robinson, Head of Research at Evans & Partners, who's live in Sydney there. Lorraine, welcome. Am I right in thinking that Bitcoin had a bit to do with it?
Well, that's probably as good a reason as any, to be honest. There wasn't any real obvious trigger for the market to fall the way it did. You know, there's been a lot of risks in the background for quite some time around interest rates, around geopolitical things, the trade wars and oil markets. So, you know, they've been there, but the US market has been largely ignoring those. So last night, nothing to suggest that that would be the night where they'd suddenly embrace them. We've had things undermine. We've had things undermine market confidence.
Yes, indeed. I mean, we've also had an incredibly sort of all-time high, numbers in the stock market, haven't we? So, I mean, there was an expectation of a correction at some stage, one would think.
Yeah, there certainly hasn't been a lot of buffer in terms of when, you know, the market gets the jitters. There's been some bad news. There's not a lot of room to move when the valuations have been, as we've seen them, at an elevated level.
What about what's been going on in the bond market and also the expectation over US rates, because that must be concerning the market, you'd think?
Yeah, I think, you know, the market now has come to the realisation that rates are going up, and they're certainly going up more than people had initially been expecting. That was made really clear when the Fed raised a couple of weeks ago. You know, that was the first time we'd really heard them say policy is still really accommodative and there's a long way to go. So the market suddenly stopped and went, oh, OK, we need to start looking at that and taking that into account. So that's certainly one of the issues that we've seen impact both bonds and equity markets.
So do we think there's another correction on the way? I mean, given that the only way is up seems to be for the Fed.
Yeah, look, certainly the futures market in the US is down as we speak, so it looks like we're in for another rough night on the US markets. What we will see is people look really closely at the upcoming third quarter reporting season. You know, people are going to be looking for signs of, one, corporate health and how profits are going, but two, also signs of inflation coming through and what that means for the speed of rate increases.
OK, I was really interested to see the difference between what was happening on the S&P and then what was happening on Nasdaq.
Yeah, look, the tech stocks obviously got hit really hard, and part of that, as you said earlier, was about valuations being pretty lofty. You also see those companies that have got lofty expectations and, you know, long-term growth more impacted when bond rates start to increase. And we saw that flow through in the Australian market today. The tech sector here was the worst performing sector today, down nearly 5.5% for the day, compared to the market down at 2.7%.
Yeah, how should Australian investors be looking at this Wall Street correction?
Look, I think if you look at the market here, we're also trading at elevated levels. So there's certainly, you know, you'd expect to see some weakness. There's certainly opportunities, though, for the sorts of companies that have got that good long-term growth profile, just to be patient and sit back and wait for those opportunities.
Lorraine, were there any opportunities that you see right now in different sectors? I mean, obviously the banks were down a lot. I don't know whether that also had to do with the hearings in Canberra. But what were the other sectors? How did they go?
Yeah, not surprisingly, you had the defensive sectors perform better today. You know, as I said, it was the tech that was hit really hard. It was those high PE, high growth names. They suffered. We also had the China exposed names hit quite hard today. Overnight, you had LVMH issue a profit report or profit warning, really talking about slowing demand out of China, and that flowed through to impact the sentiment and so the price performance of those China exposed stocks here in the Australian market.
How much of it do you think was down to a worry about the trade spat going on between the US and China, as opposed to the tightening of policy in the US?
look, it's really hard to know, to be honest. Certainly that is an issue that has built and will continue to build, because initially the market was very relaxed about, well, it won't happen, the tariffs won't come into place, we'll have a resolution. And as time's going on, that's clearly not the case. So, you know, you will start to see that real economic impact of those tariffs in the US economy. And as I say, that's one of the reasons people will be really looking at those third quarter earnings.
You mentioned the futures in New York, suggesting there's going to be another pummeling tonight. What about Europe?
Yeah, Europe had a tough night as well, not quite as bad as the States, and you know, it's hard to see what's going to separate some of these markets at the moment, because they are global issues really that are driving the shift that we're seeing in sentiment at the moment.
Yeah, and with all of this going on, I'm just wondering where emerging markets are in all this, because they've been off quite considerably in recent months, haven't they?
Yeah, they have, and they bear the brunt of the double whammy, if you like, of the higher rates in the US leading to the stronger US dollar. And so for all of those emerging economies with US dollar debt, as I say, they get that double impact, and it's difficult to see that changing in the near term.
And so back to our market, will we be looking at the US reporting season much?
We'll be looking at it for a sentiment point of view. We'll be looking at it very closely with the inflationary outlook, because, you know, clearly if rates do have to increase more quickly than expected in the US, and our rates are going to be flat for at least the next year, we think, then that suggests further pressure on the Aussie dollar going forward.
Do you have any views on the bank falls today? I mean, is there a concern about, as Brian Johnson was telling me earlier, a concern about just who gets in government-wise next year, a concern about policies around housing?
Look, I think given the Royal Commission and the issues we've seen emerge from there, our housing market certainly is slowing, but we're not in a position where you're getting enormous mortgage arrears. You know, we're still at that 1% So, you know, that's not actually, I don't think, the greatest issue facing the banks at the moment.
All right. Well, Lorraine, it's great to talk to you. Lorraine Robinson, thank you very much for joining us there.
Thank you.
Now, after the break, where to for the future of energy? Down in Melbourne here, I caught up with the top minds in the energy sector today. More on that next.
This is Ticky on Your Money, covering the big business stories.
Welcome back, and moving to the energy sector now. It's a very, very complicated area, and there are some movements on the policy front. Interesting, those comments yesterday from Energy Minister Angus Taylor, the minister obsessed with down prices for all of us. Well, to refresh your memory, the minister spoke yesterday at the AFR Energy Summit in Sydney. Now, he was calling for a mechanism dealing with energy reliability to be agreed by all the states and Labor. So does that mean the National Energy Guarantee is still knocking around? Well, interestingly, today we also heard from business that there might be some sort of group coming together. It was a leak, actually, some sort of group coming together to agree maybe a target on the emissions side. It's all very interesting and rather unclear. For more, I caught up with the Energy Minister at the sidelines of today's Outlook conference in Melbourne. Angus Taylor, you are the Minister for down electricity prices, but you announced this week that reliability was also on your radar. Can you colour that a little for us?
Well, our focus is on getting electricity prices down, but also while we keep the lights on. What we're seeing right now, Ticky, is a big investment in intermittent generation. This is typically solar and wind, and that needs to be reliable. So we need a mechanism in the electricity market to ensure that intermittent generation is firmed up, it's made reliable and secure, so that consumers, whether you're an aluminium smelter or a household, can know that they can keep the lights on, keep the machine going And this reliability guarantee will put an obligation on retailers to make sure they've got enough capacity to meet the needs of their customers well ahead of time, years ahead of time. This is a crucial initiative. We need the states to sign up to it, and we'll be asking them to sign up to this on the 26th of October.
Are you actually going to go into the market and support some of these, this firming up of renewable energy as suggested by the ACCC?
Yeah, so the ACCC did make a recommendation that there needed to be more competition and supply in the market. That was more focused on price than reliability, but can do both. And there's no question that we need to back investment in reliable generation in the system. The real risk we've got coming at us very quickly now with the withdrawal of some of the coal-fired power stations like Northern in South Australia and Hazelwood in Victoria is we don't have enough firm, secure, reliable, fair income generation that can actually keep the lights on.
And I was really surprised to see this week that even for some of the mine operating lives of existing coal and gas, that there's so much renewable energy now coming into the market that there's actually a hollowing out potentially of their models and business models, and you might find some of these coal power stations shutting earlier.
Well, so the great challenge if you're a thermal generator, there's a traditionally coal-fired power station or even gas, is that if you have all these intermittent generators coming in, you've got to flex up and down all the time. Your utilisation of your generator can drop and your economics fall away. And that's what we saw with Hazelwood, and we've seen it with Northern, and we're starting to see it with others. So there's real risks here. This reliability guarantee ensures that we're keeping that reliable baseload, dispatchable generation which is there when you need it, keeps it in the system, and that's absolutely crucial at this point.
Will that also sort out security? Because we've got the chair of the Energy Security Board, Kerry Schott, talking about anarchy out there in the marketplace. You've got this rise in renewable energy, as I say, you know, potentially hollowing out your dispatchables.
Well, she was referring the same thing as me, which is a lot of these intermittent generators coming into the system and the need to make sure that we maintain the security and reliability. And that's absolutely what we've got to do. And it's not just for households, this is also for keeping jobs in Australia. So many of our industries require, whether you're in cement or aluminium smelting or in light manufacturing, they use lots of energy. Panel beaters use lots of energy.
And you're expecting this reliability mechanism to be proved of by the states, all the states, and federal Labor? I mean, I ask this because if you tried to negotiate just the reliability side of the NEG a little while ago, you wouldn't have got the deal, would you?
Well, Labor is showing indications that they support this. We don't need their support because it's not going through the federal parliament. We do need state government support.
Including a state like South Australia?
That's right, but it's a very brave state government that signals to their voters that they don't care about reliability, particularly in states where there have been or there are forecast to be challenges with keeping the lights on. We know, the operators told us, that this summer in Victoria we've got a 1 in 3 chance or more of blackouts because of the loss of Hazelwood, the loss of that base load generation. And so I would say it's a very brave state government that says they're not going to support the reliability guarantee.
The other challenge the system is facing is that everybody seems to be going off-grid. Now, Audrey Zimmerman at IEMO talked about 6 solar panels going in per minute at the moment. Would you be looking at removing some of the subsidies put in those panels, as recommended by the ACCC, faster than is happening at the moment?
Well, all the renewable energy subsidies will phase down over the coming years. That's how they're designed, and the reason for that is they're becoming competitive in their own right.
Should it be faster, though?
Well, the large-scale subsidies will peak in 2020. The scheme lasts until 2030, but the economic impact will fade very quickly after 2020. And smaller scale, again, is phasing down from now. We're already in that process. And look, there's a good reason for a transition from subsidies to moving to a free market, if you like, because they are becoming more competitive, Ticky. And look, our challenge now is not the amount of the need to get more renewables in the system. The challenge is to manage that intermittency and keep the lights on and keep the system affordable while that's happening.
And what about fairness? Because I think we're also realising that for those who've put their solar panels in, presumably they can afford to do so, they're actually saving, what, $350 or so a year on electricity savings compared to those who haven't.
And look, you know, there's all sorts of reasons why people have put solar panels on their roofs. The point is we've got to make the system work while that's happening.
But what do you think of what the Victorian government is doing by spending, what, $1.2 billion, I think it is, by buying solar panels, you know, funded by the taxpayer to level the affordability issue? Won't that, though, skew the system as well?
Well, if you're a state government and you're encouraging intermittency into the system, this is generation that doesn't necessarily come on when you want it. It comes on when the sun shines or the wind blows, and you're not prepared to spend money on firming it up, on making it reliable or secure, then you have created a problem. Now, there's a way through this. Sign up to the reliability guarantee, and that's what we expect all state governments to do on the 26th of October. It would be grossly irresponsible for a state government not to do that.
Well, let's get to pricing. I know you talk a lot about pricing. The government is putting in a reference price for customers. Now, my question is that if the prices actually don't continue to come down, or if you don't see better behaviour from the energy companies, what are the chances of that reference price turning into a cap?
Well, Ticky, we're already seeing the beginnings of price reductions. We saw on the 1st of July the price changes made in a number of states were reductions. We need to see more. We're seeing some pretty ferocious competition right now for customers who are on standing offers. That's offers where they haven't negotiated a better price. And I encourage every electricity user listening to this, watching this, to ring your electricity provider if you haven't already done it and ask them for a better price. And the chances are, if you're on a standing offer, you will get a significantly better price.
We're seeing ferocious. But you won't rule out a cap.
Well, we need to see those prices come down. I'm confident the electricity retailers are working in the right direction, that we are seeing real competition starting to work. We're going to encourage that through this benchmark and the default price that we're setting up. But we do need to see a reduction in prices, and I look forward to that happening.
What do you think of the talks, they're rather vague at the moment this week, the idea of business coming together and addressing the emissions side of the NEG? In other words, perhaps agreeing some sort of target in order to help investment certainty?
Well, they're unsourced reports, Ticky, and so I haven't seen any detail on any of this. But what I would say is we're going to reach our 26% emissions reduction target in the electricity market. We're going to achieve it in the early 2020s.
But you don't think that impacts investment certainty?
Well, if you're going to achieve it, it shouldn't impact anything. You're going to achieve it anyway. And that's my simple point. We're going to get there. If Labor wants to increase the target, as they do, up to a 50% renewable energy target and a 45% emissions reduction target, then that will have a very big impact. And business should be very concerned, and business should try to stop that from happening. And I know there are many in the business community that think that would be an extraordinary impost. It would be a wrecking ball in the economy, and I agree with them.
Finally, it appears from your talks this week that you're sliding the rule again over Snowy 2.0. Now, this was a pet project of Malcolm Turnbull as Prime Minister. I mean, you yourself have family connections with Snowy. What are the chances that Snowy 2.0 won't actually go ahead at all?
Well, the Snowy is a great renewables project, the greatest in Australian history. It has a wonderful history. It has made a major contribution, not just to our electricity grid, but to this nation. Now, Snowy 2.0 needs to stack up, and the former Prime Minister and the current Prime Minister both shared the view that it needs to stack up. We do need more storage and more ability to firm up the intermittency in the system, which hydro is very good at doing.
But the private sector may be able to do it easier.
It's got to stack up. And look, all investments from government must stack up. I think that's a very simple rule, which this government has been very disciplined about applying across the board, and will certainly apply it in any part of the electricity market.
Angus Taylor, so much going on in energy this week. Thank you so much for sharing a little bit of it with us.
Thanks, Ticky.
Coming up, a little more on energy from the Australian Outlook Conference.
Now, back to Ticky.
Welcome back. Well, this is the Australia's 12th Annual Outlook Conference in Melbourne. It brings together thought leaders and policy influencers for rigorous discussion of issues facing Australia today. I went down to discuss the future of energy with some of the industry's biggest hitters. Energy Minister Angus Taylor, Head of Energy Security Board Dr Kerry Schott, the University of Melbourne's Dr Leslie Martin, and CEO of Meridian Australia and Powershop, Dr Ed McManus.
It's not sort of widely recognised, in fact, that the Energy Security Board has been working on the NEG since it was formally declared dead, because nobody told us to stop. So,
well, you're still working on it, aren't you?
We are, and we were directed by COAG Council to report back to them this month, which will happen in a few weeks, and then the council, which Minister Taylor chairs, will decide to hopefully proceed with the reliability obligation. The emissions obligation part of the NEG will need to be excised from the legislation, or they may decide to just leave it dormant. But the reliability obligation we've been consulting on the draft legislation, so everything's pretty much ready to go.
Minister Angus Taylor, can I ask you to drill down or colour in a little bit of exactly how this reliability mechanism, this stability mechanism will work?
Look, I think it's a very elegant mechanism. I was actually in favour of it right from the start, and the reason is that it's based on a trigger which only comes into play if it's clear that there is a gap in the market, a reliability gap in the market. If that trigger is pulled, so to speak, then a whole series of consequences flow from that, the most important one of which is that the retailers will have an obligation to make sure they've got enough capacity available to meet the demand of their customers. It's not a capacity market as such, but it is there to underpin enough capacity to meet customers' needs in markets where there are shortages. If we look across Australia, every market's in a different state. We've obviously seen more capacity issues in South Australia, and increasingly I think we expect, based on AEMO's numbers, to see that in Victoria and New South Wales over time, and Queensland is probably in the best position of all of those states.
So are you expecting COAG to endorse this later this month? Because Mark Butler, federally Labor, seemed broadly open to it. I ask it because if this sort of suggestion by itself had been put up during the NEG discussions, you'd have been laughed out of the room, wouldn't you?
A reliability obligation?
Just purely reliability without considering emissions.
So let's be clear about this. There are only two parts to the NEG. One is reliability, we're proceeding with that. The other is emissions. We are very confident we'll reach the 26% emissions target, and the reason is very simple. Kerry actually, I think most of the speakers have said it, we're going to see record levels of investment in renewables this year and next year. Combination of small scale, large scale, they're big numbers.
But is it the crisis
and so for that reason, Ticky, just let me finish for a second, we know from the modelling that's already been done by the ESB, we're very close in the early 2020s. That was based on forecasts 6 months ago that are now out of date. And so what we are seeing is for a variety of reasons, and we can question whether these were good policies or not, and I've said things about that in the past, but for whatever reason, it's happening very quickly, and our challenge is not to reach the 26%. I think we're going to get there in a canter, as the Prime Minister likes to say. Our challenge is to actually stabilise a system which still has big aluminium smelters and other big machines on the front end that need inertia, that need reliability, need security.
But you're getting broad support for this, you're hoping, well, because of the urgency of the situation, do you think?
Look, I think it's a very brave state, that is going into a summer that's going to be tough, that says we're not going to support the reliability obligation.
Okay.
That's a very brave state.
All right, Ed McManus, how do you think, there are so many moving parts, but essentially we've got the cost of maintaining the coal plants, which are being threatened by all this renewable energy coming in. It was called hollowing out. It's been called hollowing out this week. On the other hand, we've got the cost that you described in your talk of firming up renewables. How do you, going forward in a system, make sure that transition is smooth?
Well, look, tough question. It's hard.
I'll ask Kerry afterwards.
It's hard. One of the important things is that one of the areas we align on, people might be surprised on that, is that we think subsidies should end. Now, we've been a recipient of subsidies in the past, and as people know, the large-scale RET finishes in 2030, but the level of subsidy diminishes vastly from 2020 because of the way the mechanism is designed. Now subsidies distort markets. And the reason that's important, if you get a hollowing out, right, imagine the daytime price, because of lots of solar, goes to $7. And therefore a coal plant that needs to run to maintain reliability and security is losing money. Bear in mind that the solar owner or the wind owner is losing money too. Yes, the short-run marginal cost is zero, but if I'm only making $7 back on a solar plant, I'm losing money. So to some extent, in a properly functioning, efficient market, this should be self-correcting for a number of reasons. You'll see investment back off if wholesale price hollows out. You'll see users of electricity drive into those times of the day, driving up demand. So I think that side of things worries me less. The security side, remembering that security and reliability are different things, is probably more of a challenge to manage because there's not a market for that today as such.
All right, Leslie, can I bring you in here? Because if I can add to this the sort of figures that Kerry was talking about in terms of solar in homes, 6 new solar panels a minute, Aubrey Zimmerman from AEMA was telling everybody this week. Now, do you think that the subsidy to put in a solar panel should still be there? Because the ACCC certainly thinks it should go.
So I would strongly prefer having a price on carbon than having subsidies on individual renewables.
Well, you can't have that, sorry.
You asked me for the first best. I think that's the first best.
But now, given what we've got here, do you think those subsidies should go? Because at the moment, the people are going off-grid and presumably threatening the stability of the grid tremendously.
Well, so I think there's two separate questions. Is one, do we want to price the intermittency that they're creating, and how do we do that? And two is, how do we figure out how to recoup the fixed costs associated with all of the transmission and distribution that someone who is running a solar panel is not then pitching back into, right? And so I think that because we've committed to the people who install the network that that cost is somehow going to be borne, we then need to decide who's going to pay for it. So is it going to be the current rate users? Yep. Is it going to be general taxpayers? Or is it going to be the investors? And investors also mean mom and pop and pensioners and all the rest. And so that separate part of the question is, how are we going to pay for that? And so I think there is one question of, okay, so do we want to keep those subsidies, given that we can't in this have this carbon price? And then the second is, how do we want to figure out how we're going to pay back that sunk cost? And sort of these two are very linked, because how we pay back the sunk cost, to the extent that it's only going to be current rate users who are paying it, that's going to encourage much more solar adoption, and that's going to exacerbate the cycle.
Angus Taylor, if I could ask you again, Jennifer Westacott today was talking about addressing the disadvantaged. Well, in that ACCC report, you've got the difference between those on solar and those not. I think was it $350 a year or something of that order at the moment. It's another reason to pull away these subsidies. Will the government agree with the ACCC recommendations to stop them by 2021 rather than leave them hanging around to 2030?
Well, they are phased out, let's be clear. And
Over a
Ed
long
talked about
period.
that. Well, it depends. The LRED actually, on forward prices, is down at about a third of the current cost by 2021.
And beyond that, almost zero.
Almost zero.
It's effectively gone by 2021.
2021 or 2022.
In value.
Yeah, exactly. So, you know, the phase out there is reasonably quick. It's slower with the reduction in the deeming rates on the solar side. But, you know, those schemes have been in place. I've been very public in my views on that in the past, because my view always was we were putting a lot of intermittency into a system without mechanisms to deal with that.
So you say government's going to move shortly?
Well, these are phasing out, you see, and this is the point. We can have a long esoteric debate about what year they should all be phased out by and what year they are being phased out effectively by what the market's doing. But the important point is they are, and the crucial point is that we are going to reach the 26% target well ahead of time on the trajectory we're on very easily.
Right.
And so let's not agonise over it. We have agonised over this for too long, too much. Okay. Let's focus on the thing that we can fix now, which is getting the reliability and the security of the system right and getting the prices down, because I do think high prices are a problem. Look, you wander through my electorate and you ask the individual businesses and households.
Prices are a problem. Investment certainty. Well, wait a minute. So investment certainty is also an issue to the extent that Kerry Schott, you're obviously not satisfied with only one half of the neg. You suggested this week that if government was not able to agree with Labor on the emissions side of things, then either business or COAG should take it up themselves. We're now hearing that business is going to be doing precisely that. Are you confident that they'll be able to achieve much, and how should they do it?
Just on the management of the emissions side of things, to get an orderly transition, we really do need to manage the way in which the emissions are coming in, and we've been mainly talking about generation and sort of the reliability side of things, but the very fast way that the emissions are coming into the system is causing all sorts of security dramas for transmission and for distribution.
Watch that space on the business side. That's all for the show tonight. Tomorrow night, talking groundbreaking urban development with some of the world's most successful developers. Until then, thanks for your company.